Hello and welcome to BQ Prime. You're joining us on the second day of the JP Morgan India Investors Summit. Here I'm joined with Mr. Luis Oganes from JP Morgan. Luis, welcome to this conversation. I want to start this chat with a little bit of the current sort of volatile global environment that exists versus in India, where things are not as volatile as some of the other economies are there. But how are you reading the situation as far as India is concerned and the broader Southeast Asian region?
Well, it's interesting world dynamics these days where you have the U.S. outperforming in growth, right? I mean, we started the year forecasting that there could be a U.S. recession in sometime in the second half of the year. Well, a recession in the U.S. is nowhere to be seen. We keep upgrading our growth projections there. And of course, there's no free lunch in economics. So there is a feeling that, if there's resiliency in growth, maybe there's also going to be resiliency in inflation and in the labor market, and that the Fed may need to do more. So I think that even though the base case is that the Fed is done, that's still the possibility that they may need to do more, is still there. Europe, on the contrary, is underperforming. China is also losing momentum. So you have these divergent dynamics around the world. And when you look at India, I would say that it is in a very good place in terms of, investors looking for countries that can benefit from this global economic and geopolitical cross currents, right. And India seems to be, a prime beneficiary of that. But of course, a lot of that, is going to take time. It's more a hope than a reality right now. But I think that there's, quite a bit of hype. I'm here in Mumbai. I come every year for the India Summit of JP Morgan. But I would say that the interest this time around has been a lot stronger than in the past.
All right, fair enough. I wanted to bring in a little bit about the volatility and discuss that a little more. In the recent few weeks, we've seen the crude oil prices spike up again, commodity prices spike up again. At the same time, you've got the Federal Reserve, which is not really showing its cards on the table as to what it's going to do for the rest of the year. There is an estimate that there's going to be one more rate hike from them, but the market broadly believes that they're done. But in this scenario, how should emerging market central banks look at what they need to do? Because so far they've been on pause, at least here in Asia. They've been on pause, but for the future, what should they read into the current data?
So the biggest message, I think, from the Fed, whether or not there's another hike coming, is that rates are going to stay high for long.
Yeah.
Right. And so the expectation that we may see, remember that we started the year pricing rate cuts in the second half of this year. Of course, that's gone. Pricing 200 basis points of cuts by the Fed in 2024. Now, at this stage, it is a little bit less than 100 basis points that is being discounted by the yield curve. And my gut feeling tells me that that's going to keep shrinking, right? Further. So basically, that the market is going to continue to reassess, that the Fed is going to need to keep rates high for longer because inflation needs time to come down to closer to target, right? So in that kind of environment of higher for longer of Fed, and it's not only the Fed, it's also the ECB, the message is there, and other DM central banks. I think that EM central banks are going to have a tougher time cutting rates. We do have some central banks cutting rates, but it is because they hiked a lot in the last couple of years. And I'm talking about the Mexicos, the Brazils, and Chiles of the world, in where you see the nominal and real policy rate, 4%, 5%, 6% real terms, which is very high, right? Yeah. In the case of India, Asia, you already mentioned, Asia didn't hike as much, actually, because inflation was not as pervasive in this time zone, in this region. So therefore, rates are not as high. And so there's no pressure to cut from that perspective and no space to cut from that perspective at a time when we don't know what the Fed will be doing, right? In the particular case of the RBI here in India, we have our first cut penciled in only for the middle of 2024.
Right.
But that is contingent on the Fed being ready to cut in the third quarter of next year. If you have a situation where the Fed is still in hiking mode, or we're still in a situation where the labor market dynamics are still strong and the dollar is still appreciating, I think that the RBI itself may need to wait longer.
Push back. Yeah. Because the RBI is particularly, first it was the crude prices problem with the geopolitical tensions between Russia and Ukraine. Then you had domestic food, sort of spiking up the headline inflation number. Now we're back again on the crude cycle. they don't seem to be catching a break at all. It's just a tough time for them, right? I mean, as far as the policy is concerned.
It's a tough time for central banks around the world. To be honest, it's a tough moment to be a central banker because these inflation dynamics. Remember, just before the pandemic, or even the early start of the pandemic, we were thinking that inflation is dead, right?
Yeah.
I mean, it's not coming back, and guess what? A year later, the entire planet was under pressure and price pressures, right? So it's hard to you cannot really blame the central banks. If anything, central banks are doing what they need to do, which is tighten when inflation is higher, right? And that they're trying to calibrate. I think that the challenge is that they're trying to calibrate enough tightening to prevent pushing economies into a recession. But that calibration is not perfect science, and that's why we're doubting in the case of the U.S. itself, right, whether there's going to need to be more tightening, but that could certainly tilt the economy into recession. The probability of that is certainly not zero.
In June, you had recommended an overweight on the EM bonds, and has that view at all changed with the current scenario?
Yes, because we had we were looking at an environment where the dollar was actually quite stable, and central banks in EM, as I said before, they had hiked so much they started to cut. The initial rate cuts by some central banks in Latin America and Central and Eastern Europe were actually larger than what we were expecting, larger than what markets were discounting. So there was a case to be made to be invested in local currency bonds at a time when the dollar is stable, so there was no need to hedge the currency risk. And what's not there to like, we call it carry trades, right?
Yeah.
I mean, in local currency bonds. But the dynamics have changed a bit, particularly because the market is now pricing in a higher for longer rates environment in the US and DM central banks, which is, if you think about it, many investors tell us, I can get in 3-month money market funds in dollars, 5.5% interest rate.
Right.
Why would I bother to go into emerging markets, which de facto are riskier, to get something similar or lower, right, for that interest rate? It makes no sense. So there's a lot of competition coming from the Fed itself.
So we've seen the local currency here depreciate against the dollar quite a bit. It's settling at about $83. Are we closer to the actual level as far as emerging markets are concerned? Are we closer to that actual level, or do you think that maybe they need to weaken a little more?
Actually, around 83, we think that the rupee is very close to what we consider fair value. If you, and this is one reason why now that the Fed is hiking rates, we have not seen excessive currency pressure, right? Which happened actually, if you may remember, 10 years ago, 2013, the so-called taper tantrum, right? The rupee was quite overvalued, right? Had appreciated in the run-up to that episode. So when at that time, Mr. Bernanke said that the Fed needed to taper the bond bond buying by the Fed. Well, all hell broke loose, right? And you started to see massive capital outflows from emerging markets, putting a lot of pressure on currencies and central banks to hike at that time. That hasn't happened this time around, which is good news, right? But that tells you that the currency, the rupee and other currencies in EM are probably not so dislocated, either overvalued or significantly undervalued. So I would think that, to be honest, in the last year or so, the last few years, now that the current account deficit has narrowed in India, the RBI has actually been in a position to accumulate reserves. So in a way, they have been actually fighting appreciation as opposed to depreciation, right? But not letting the currency appreciate so much. So I would say that at this stage, probably the spot is, much closer to fair value. And so long as the external accounts contribute, we may not see too much pressure coming from maybe additional rate hikes in the U.S.
Okay. Good you mentioned the Reserve Bank and the Forex reserves, because that was going to be my next question with regard to the current status of the Forex reserves that are here in India, about 600 odd billion that we're holding, and the RBI is actively intervening in the market as and when they see volatility on each end. But just trying to understand from you, what is the ideal way forward as far as utilizing these forex reserves are concerned, because they are fairly large in terms of what the country actually needs.
Well, it's hard to say what is the optimal level of reserves, right? Some people say, well, you should have at least one full year of 12 months of import coverage. It is expensive actually to carry reserve, right? Because oftentimes the interest rates are low in dollars, and and you have to use that to fund to issue currency in local currency that has a higher interest rate. But we are in a particular situation right now. Well, first of all, there was a lesson to be learned during the taper tantrum that at that time probably reserves were not sufficient, not high enough, right? And that's why currencies depreciated a lot. At that time, in the case of India, I think that it was only 6 months of import coverage that was the stock, right? Which under normal circumstances you would say, well, that's enough, right? Why bother with more? Well, the market determined that it was not enough, right? And that's why the rupee came under significant pressure, forced the RBI to start, to increase interest rates. And the lesson that the RBI learned that I think wisely applied in the subsequent years was to, we need a higher cushion to withstand a similar shock down the road. And they're reaping the benefit of that, because we're not seeing now a massive need to contain currency pressures or a massive need to increase interest rates because the Fed is hiking, right? I think that the latest number, 620 billion, I believe the latest stock reserves is around 11 months of import coverage. Certainly feels, the market certainly is much more comfortable with that, right? And that's why you're not seeing the speculative pressure on, against the rupee right now.
Fair enough. Speaking a little bit about the sort of measures that the government is taking in terms of having rupee act as a settlement sort of currency as far as international trade is concerned in India. Now, there is a slightly uninformed debate about it becoming a reserve currency, which I don't think is practical. But even in terms of trade settlement, I'm just trying to understand: is this something worth following, worth tracking?
Well, there's many countries that, given what has been happening in recent years with the U.S. deciding to quote-unquote weaponize the dollar, right? Looking for alternative ways to not necessarily depend or fully rely on the dollar for trade or for reserve accumulation or otherwise, right? And there's that talk about de-dollarization, and there's a larger share of commodities that are being traded away from the dollar. This particularly affects the countries that are under sanctions, like Venezuela, like Russia, etc., Iran, right? But in the case of India, I think that the interest of having more of trade settled in rupee, is, in the strictly speaking, is not a bad thing, but there is a practical element to it, which is twofold. First, the Indian rupee is still not a convertible currency, right? It's not that I wake up in the middle of the Indian night somewhere around the planet and I can buy and sell rupee if the market here is not open, and there's all kinds of capital controls that restrict, buying and selling of rupee to begin with, right? So until that is not lifted, that I don't think is going to be happening anytime soon, I don't think it's going to be easy for anyone to accumulate savings around the world or you see the rupee as a reserve currency. Second is that even if India enters into bilateral agreements with other countries in order to settle trade, exports and imports in rupee, you need to find countries where the export and import dynamics between the bilateral trade with that country is kind of equivalent, meaning that India sells as much as it buys from these countries, so that over time these flows kind of settle and neutralize each other. Otherwise, the other country would be forced to accumulate rupees as a reserve. And again, it's a difficult thing to do if the capital account here is not open. So I think that we may see more of that, but I think it's going to be, in the grand scheme of things, limited. And all the voices that keep calling, okay, the dollar is turning the corner, there's a de-dollarization trend around the world. At the margin there is, because there is more settlement of a lot of trade happening away from the dollar. But I don't think the dollar is anywhere near about being dethroned. And to be honest, I don't know whether in our lifetimes we may see that, because the euro at some point was hoping to be one. and the situation that didn't pan out well. The Chinese are trying to push for the renminbi, but they're trying to have their cake and eat it. It doesn't work that way, right? They still have a lot of capital controls, right? And they are afraid that if they lift all the capital controls to make the currency convertible, guess what? Probably the Chinese investors themselves, retail and institutional and corporate, will be the first ones exiting, rush out. So they don't want that.
Okay. I will bring in the last question here, and I wanted to get your view on the, you mentioned that we were predicting a recession, at least in the developed economies, just a few months ago, and then now suddenly that view has changed into maybe not. But the slowness of the slowdown is something that your colleague Jangir Aziz mentioned with us. But the slowness of the slowdown, has that surprised you a lot? And also, what does that mean for the next, say, 6 to 12 months?
The reality is that so many of the initial conditions for what is happening right now is so unique that history was not necessarily a good guide. And what I'm talking about is a situation where during the pandemic, you had a lot of policy support coming from fiscal policy, monetary policy, that allowed households, basically families, individuals, and corporates to accumulate quite a bit of savings, right? We were all locked up at home. Those of us that were lucky enough to keep our jobs, keep receiving income without being able to spend. And those that lost their jobs, but that had some kind of government support to have some subsistence income, same thing, right? So post-pandemic, all of a sudden, savings levels were quite high, and that helped in a world where inflation went up, interest rate went up, the world kept spending. So, whether this is about to be over, certainly we see the stock of savings coming down, which means that, at some point, this is, we cannot make the bet that a recession will not happen, right? The issue is timing, right? So right now, again, the base case scenario of our U.S. economists is that the U.S. goes into what we call a soft landing, meaning growth may go to zero, but not into negative territory. But this assumes that the Fed is done, and that the policy rate at 5.5 is enough to bring inflation back to target in the next couple of years. If that doesn't happen, which may well be the case because labor markets are still so tight and the Fed needs to do more, you cannot rule out that we may eventually end this cycle with a recession, right? It doesn't need to be a very deep recession. We're not talking about a crisis level of recession like the global financial crisis. It could be negative 0.5% for a couple of quarters, which, at some level will be almost imperceptible, but that is recession, right? That is the definition of recession. So I think, if you look at the probability distribution that our own economies have, at this stage, even though the model view is that there's a soft landing, the probability of soft landing is actually maybe around 40%, and the probability of recession of some sort is 60%, right? So there's still more. The issue is timing, right? Certainly not this year, maybe not even the first half of next year, but first half of next year, second half of next year, or 2025, honestly, the question mark is humongous, right? So.
All right. Thank you so much, Luis Oganes, for joining us on this conversation. Pleasure talking to you, sir. Thank you so much for watching. Please do tune into BQ Prime for further news and updates.